everyone, Swing Pony here. Welcome to the Place Your Trades Network, where we discuss trading daily options using CME Group's event contracts. They give us access to over 10 different futures markets, including NQ, ES, natural gas, copper, gold, and more. We have a great show ahead. Markets and Mayhem is going to be joining me. Perfect timing with everything we have going on post FOMC and really this bullish rally that we've been seeing that has everybody wondering, is the bear market over? So we'll go ahead and get him on here in just a bit. He's going to give us a macro overview, and he's also going to discuss how to manage bias. I think it's been a tricky market in the sense that it seems like every single economic event matters. The macros are always being talked about, and it's really difficult sometimes to trade on a day-to-day basis and not take that bias into the price action that's in front of you. So great conversation ahead. This broadcast is brought to you by Tradeovate. They've created a custom app where we all trade these event contracts, and we are actually hosting a giveaway for Las Vegas. So the Place Your Trades team and I are going to be in the Money Show in April, and we're giving away one trip to have one person join us. So if you want to enter to win, all you have to do is go to placeyourtrades.com/Vegas and enter before March 1st. It's going to be a blast, and I think it'd be a lot of fun if you met us there. Let's go ahead and get Markets and Mayhem out here. Hello.
Hey, how's it going, Swing Pony?
Good. How are you?
I'm doing well, thank you.
Having fun in this market?
It is no shortage of fun. Every day there is a new twist, a new turn to the plot, and it makes it exciting.
It really does. And I love having you on as a guest, because we just had FOMC. We got the 25 points that we were expecting. Market obviously loved it. It's been an interesting market in the sense that I feel like the macros are being talked about more than ever. I feel like economic events carry so much more weight than they used to. And I feel like there's a lot of people constantly predicting like, oh, we're going to hit this and then we're getting all-time lows, or like we're entering into a new bull market. And so it's an interesting time to have somebody come on and sort of discuss what you're seeing from a macro perspective, kind of what's catching your eye, but then also a little bit of how you're able to be so immersed in the macros, but not let that bias take over when you're trading day to day.
Yeah, absolutely. Thank you so much for the opportunity to come on. I really appreciate it. We've been following each other on Twitter for a while, so it's awesome to be able to have this interaction. And I think that everything you're discussing is really quite on point. I mean, looking at this from a longer term picture, we can't let that big picture color our day trades or even some of our shorter time frame swing trades, because, like in any situation, there are going to be, in a bear market, powerful counter trend rallies. In a bull market, there's going to be drops and there's going to be fake outs. And so you have to kind of acclimate oneself to different time frames and how we adjust to trade the market we're in rather than the market we expect to see. And I think a lot of that comes down to having a more systematic approach, governing that bias, governing emotions, governing the impulse to take on trades based on that sort of thing, and really looking at things more from the perspective of, what fits my criteria to take on a trade from a technical basis, or from a more systematic approach if I'm looking at like relative strength or relative weakness versus what do I think might happen. Because, there's a lot of other smart people that participate in the market as well. And we can't just assume that some of these ideas aren't already being priced in, right? So we have to look at it from a longer term perspective. For swing trades, macro ideas are great for like longer term trades, but for shorter term trades, it's often much more driven by order flow and, by technicals, and really these days by options.
All those zero DTEs, now that we've got SPY and FTX every single day, zero DTE. I mean, it's wild.
It is. There's over $1 trillion of SPX notional options premium being traded every day, and almost 50% of it, and some days in excess of 50% of it, is expiring in 6.5 hours or less.
That's crazy. I mean, people who are selling premium, I think, are the ones who are making the money, because I just can't imagine, with zero DTs being so readily available all the time now, how much of those premiums are just being set on fire.
It's really what I've seen when I've been playing them and when I've been kind of observing them as well, getting to know their character, is it's often what you think is the least likely to happen, what the market is thinking is the least likely to happen makes the most money. So when you have a day where we start off, as many days have, with like a fall right at the cash open, and these things get discounted to 50 cents or a buck each, it's often around that point of time where it's the best opportunity when it looks like we're about to go off a cliff. You'll wouldn't you know it, by 2 p.m. they've gone up tenfold.
1000%, especially, well, 1000% literally. When you get those kill candles, a lot of times, like those liquidity grabs, like those are the opportunities to, if you like where you're on the chart. I actually really like to pull up the options premium charts too, because that's a really great
Definitely.
way to sort of see, you know, what the support and resistance there is. Like if I'm buying right now, am I buying at a level that makes sense? That's helped me out a lot in my trading. But yeah, I totally agree in terms of the zero DTEs. Those have totally changed the game. But I want to talk to you a little bit about the macro side.
Sure.
I think what you said about everything else was really interesting because in my feed in particular, there's a ton of people that I know are day traders. It's hard not to be curious about the macros. It's very hard not to want to predict. And, sometimes it is fun to have predictions, but I find with myself, even once I get in the nature of predicting, that bias is already starting to happen. There's a little bit of, even if I can say like, oh, I'm just predicting for fun, I know that expectation sort of stays with me and it affects my day-to-day trading. So I'm trying to do a better job of sort of separating what's more of a long-term vision versus like, just trading the daily market, and then also being aware of any economic event. Because I think the kind of market we're in right now is if you're trading on a day where you're not aware of something that's happening, you could get hit pretty hard.
Absolutely. Absolutely. Yeah. And I think that's really important. And the way that I try to do it is I look at the time horizon for the thesis as to how it may color my point of view, if at all. So for a lot
Mhm.
of the stuff I look at on the macro side, it's stuff that's going to take a quarter, 6 months, a year or two to play out. And so I need to make sure that I'm only factoring it into trades that are going to have, or investments that are going to have, those types of time horizons. Whereas,
Sure.
for shorter term trades, particularly day trades and multi-day trades, it's much more about, flow and options, technicals, key levels. It's very little about what one would think moves the markets. And part of that has to do with the fact that so many market participants are forward looking, that there are hedges that go into place. And so you have these counterintuitive moves after an event volatility catalyst is behind us. Maybe it wasn't great data, but it wasn't as bad as the market hedged for. So they remove those
Sure.
hedges. That adds liquidity. We get a bid. And I think that's where a lot of people that try to color day trading with macro views can get caught off guard, because what happens is a bigger term picture. People are hedging into that event. They weren't trading for that event. And so you might get this sort of counterintuitive reaction. But once we start to kind of analyze and examine that, having that longer term point of view to at least understand why we get those reactions day by day can be helpful. Like looking at hedging going into CPI. Are people hedging heavily? Well, if CPI comes in a little cooler than expected, the reaction will probably be even more violent to the upside. And that sort of stuff can certainly help with kind of coloring expectations on a day by day basis. But I think it's really important for everyone, especially folks that are trading, minute by minute, hour by hour, to really look
Mhm.
at the market more as trade what's in front of you, trade price. Don't worry about the bigger picture narrative, because if you're trading for the black swan event or the left tail risk, it's more likely not going to happen than is during that time frame.
So you've put together this great presentation, and I'm really curious because more than ever, I'm seeing people, starting to compare charts to 2008. That's showing up on my feed all the time. The words recession, the word inflation, the egg shortage, everything that's going on, these words are making really big headlines to where people who aren't necessarily in the finance world, they're not traders, these are becoming topics of conversation outside of the market. And it sort of proposes this like, when everyone's expecting something to happen, does it happen? How far out, is this limit down, recession crisis the market is, supposedly going to see? Like, when is that going to happen? There's a lot of thoughts that people have. And now that they're becoming spoken about even more, it just makes me curious in terms of what you actually see in terms of a macro point of view, how we figure out, what is priced in, what isn't priced in.
Yeah, absolutely. Those are all great questions. And it is interesting to see how we've gone from a market where sort of everyone was a day trader to a market where everyone's a self anointed macro expert.
Yes. Yeah,
um,
totally.
I would say that, there is some question about collective psychology and whether, if enough people believe we're going to get in a recession, if that changes behavior enough that it makes it more likely, or if we can be more contrarian about it and say, well, if everyone expects it, maybe it's less likely to happen. My point of view on this is that, we're probably leaning more towards an actual recession, but I'm not sure exactly when it's going to come about. It could kind of catch people off guard a little bit because the soft landing narrative has become pretty prevalent that, we're just going to kind of slow down a bit. We're not going to see, employment come down too much or the economy come down too much. Sort of what Jay Powell talked about during his press conference, that we're kind of maybe guiding to more of a slowdown rather than a recession. I would think that perhaps the idea of a recession is just a little bit more likely than what is priced in, only because I don't think we've reconciled some of the structural problems in the economy that might lead us to that point. And I think unless and until we do something like that, and as long as the Fed sort of has this idea of staying higher for longer, some of these cumulative impacts will begin to cause more damage. There are still some latent impacts on Fed policy, and particularly the appreciation of the rate of what capital costs and how it affects governments and businesses and households. But we're starting to see some of that. And the chart I have on screen here is a chart of money supply. So we're looking at all the money in the economy, and what we're seeing is that it's fallen. The black line is now in the negative for the first time, really,
Mhm.
in a very, very long time. Like, this is not something the chart even covers. So we're going back over at this
Wow.
point, 53 years, 60. I'm sorry, 63 years. And then on the other side, we're seeing real money supply, or money supply adjusted for inflation, is falling to levels we haven't seen since the 1980s. Now, what that tells us is there's not enough money in the system to pay the interest on the debts that are accruing at a more rapid rate, particularly on revolving lines of credit like credit cards or revolvers for corporations, because interest rates are rising. So the debt burden is increasing. So it makes it more likely there'll be delinquency or default. It also makes it more likely that you'll see some challenges in the economic and market environment. So this is a bit of an eye popper. It's one that has me concerned a little bit because, we're still in an environment where liquidity is being removed from the financial system via QT in the amount of $90 billion a month.
I've been seeing a lot of those charts lately about how credit card debt is rising
Yes.
and savings are on the decline. And it's a very jarring visual. And to think, we haven't even headed towards the worst quite yet. What is that chart going to look like further down the line?
And I think that's a very, very good question, because typically when we see those levels of stress, it's more when we're getting closer to or already in the recession. And yet we're
Mm,
seeing that before. We're seeing a consumer where, a lot of people are having trouble paying down their debt. So here's the next chart. 40% of consumers are having difficulty paying their bills.
wow.
And that's a bit of a concern because our economy is driven by 2/3 consumption. Consumers are the economy. And the last GDP print we just got for December, it looks good on the surface, right? 2.9%. There's a lot to be happy about. But when we take that apart, inventory building was a primary driver of that. So that's temporary. Companies aren't going to keep building inventory if consumers are buying less. And then the
Mhm.
imbalance between exports, falling less and imports falling more helped to drive GDP, as did an 11% increase in non-government or non-defense government spending. The CHIPS Act, the Inflation Reduction Act, temporary stuff. There's going to be a little bit more pullback in government spending this year versus what we saw in years prior. And the consumer of that 2.9% was 0.2%. Typically, they're 2/3 of GDP, any kind of sustainable, durable economic expansion. And yet this time they were barely anywhere to be seen. So it's a little concerning.
Yeah.
Then we have rises in auto delinquencies.
Oh,
And this is the highest that we've seen in quite a while, going back to 2018 when things were getting ostensibly more difficult as rates were rising. But this is also a higher level than what we saw during the great financial crisis.
interesting.
And so when we look at the impacts in the auto market, which is a pretty big part of the global economy, it's significant. We have domestic auto sales in blue, foreign auto sales in red, and they're falling below levels we saw during the great financial crisis. And
So
I'm
it's
not
kind
trying
of
to
feels
make
like the perfect storm is sort of brewing. Like, I'm going to be funny for a second. We have SPY trading over the trend line, but there's all this stuff kind of under the hood, so it kind of gets you thinking, in terms of where we are in the market, like there's still a lot to work through.
Yes, and I think there are reasons as to why the market's been trading as it has been, and I'm going to be very excited to get into those in just a few slides. But I wanted to go through just a couple more areas of the economy first, because, like you said, and this is the chart you were mentioning, there are some things to be kind of concerned about. There's credit cards in blue, there's the savings rate in red. We can see that dramatic departure, and that's very disconcerting because a lot of that revolving credit card debt is credit cards, and credit cards have APRs of 20% or higher. So imagine that compounding interest just eating away people's ability to save any money. We can see it right in that chart.
I mean, credit card interest is almost like, at a certain point, it almost feels like impossible to climb out of, just because that interest is tacking on so much. Your monthly payments don't even go that far anymore.
Exactly. And 2/3 are living paycheck to paycheck of all families in America, all the income earners. 2/3 of them are struggling. 40%, like we talked about, behind on payments. And here's the big thing, though. Usually credit cards are used for all sorts of different things, including discretionary spending, like going to the store, buying new flat screen TV, new video game, whatever. Most of the expenses right now that people are accruing debt on are rent, utilities, food, gas, the necessities.
Hmm. That's very concerning. Yeah.
And home sales are falling. Home sales, the whole residential real estate market's about 15 to 18% of the economy. And the blue line is a composite of different measures of home sales, existing, new home sales, and so forth. It's really a measure of the health of home builders. And just to show you the sort of la-la land that we live in the market, the green line is the home builders ETF, which has enjoyed a rather strong positive correlation with the National Association of Home Builders Index until lately, where it's sort of like, I'm going to ignore reality. This is fine.
Interesting. Interesting. That's quite a disconnect there, huh?
It is, and I feel it will eventually be reconciled to the downside. We'll obviously have to see what happens, but existing home sales are plummeting to levels we haven't seen since 2010. Fundamentals are deteriorating for home builders. We're seeing their new orders and backlog drop significantly. KB Home came out with their earnings earlier last month, and they said their new orders net are down 80% year over year.
I mean, look, during the COVID era, I mean, when did it start? When did it end is a great question. But I remember everybody was house hungry, going $100,000 over ask, going $200,000 over ask. I'm in LA, if that, kind of explains why people go over ask so much. But, giving up contingencies, doing all these things to just lock down a house. And when something is so euphoric to that level, you just think to yourself, it's probably not going to end well.
Exactly. Like we saw the videos going around on YouTube and TikTok where they were like, I've got 10 rental properties. I've got 50 rental properties. I've got 250 rental properties. And I'm like, oh my goodness. Who are
You're like, I know how this ends. It's not good.
Right. So it's an interesting dynamic because when housing affordability is put onto a chart, we can see that we're actually at levels that are less affordable than they were before the great financial crisis. And again, not trying to make too many analogs here, just showing extremes. This time is different because less of the mortgage composition is, adjustable rate mortgages, but it's not different in the sense that many people, in fact, more than ever before, are priced out of this market when 42.3% of income is necessary to cover the cost of mortgage, taxes, and insurance. And that's higher than the peak of 2006, which was 41.7%. That means a lot of people can't afford a house, and something like 50% of millennial-aged people are living with their families. So that was before COVID.
Yeah, I find that fascinating because, culturally, so I'm Persian, Iranian, there are certain cultures where it is normal to sort of live with the parents, right? But I've seen an interesting shift lately where it expands far beyond that demographic, where it's kind of become a lot more normal for people of all backgrounds and ethnicities.
And it's like not because of a cultural reason, right? It's out of financial necessity, and it's becoming normalized because it's like, well, we just can't. And millennials are now in the prime home buying years. If we look at prior historical norms, and yet they're priced out. So it creates a kind of quandary because you've got older people, they're retiring. They're not, they don't have the kids at home anymore. They can shrink the size of their house, or maybe they're going into assisted living, or God forbid, maybe they're passing on. Where is the
Sure.
demand going to come from to pull up that housing stock?
Ah, interesting.
So that's a
Interesting.
concern because so many are priced out. Prices have to go down quite a
Let
bit to
me,
get people back in.
let me ask you this. How long do you think it could take for housing prices to come down to a level that is more affordable, is more attainable for everyday people? Is that something that's, within the near future? Or is it way further out? Do you have any insight there?
I think it has a lot to do with how long the Fed allows their policy to run. But if natural forces are allowed to manifest, with mortgage rates having risen well over 6%, nearly doubling since their start in 2022 of just over 3%, I think that
Mhm.
you're going to have a lot more people that are going to be selling houses at appreciably lower prices. And we've already seen it start. Housing market's been its own price recession since June of 2022. Now, prices have not fallen enough, and our market is actually surprisingly one of the least vulnerable, even though it's quite vulnerable. If you look at Canada, UK, New Zealand, Australia, other countries have a much higher composition of variable rate mortgages. So they're probably going to have faster deterioration and more significant in their housing markets. And Canada, in of itself, has one of the biggest housing bubbles in the world right now, and it's probably going to get kind of bad there. But for here, I think if natural forces are allowed to play out, you've got a lot of folks that bought second, third homes for Airbnbs, for vacations. You've got investors that bought whole swaths of rental properties, as we were joking about, but it is a serious imbalance and it's a lot of supply that could be unlocked. And then you've got institutional investors that bought commercial and residential properties, a lot of multifamily units, but single family homes as well. And what that's telling us is that when rates rise and liquidity drops and the market starts to really sag more, and folks are trying to wonder whether they're going to be able to get out with any profit, break even, or underwater on their equity, sellers are going to become more motivated. Supply is going to increase. We already have a backlog of about 3 months of supply on the market. So I think that what we have to see is price has to reach buyers. This has become a buyer's market. It'll probably
Sure.
remain as such. And I'm hoping that, if the Fed does see fit to kind of keep financial conditions as tight as they're willing to keep them for a while yet, that natural forces would bring down home prices by anywhere between 30, maybe 40% in some of the hotter areas, and 20, 30% as kind of a national average. That's not going to make the average home that much more affordable because the cost of home ownership has more than doubled since COVID start, but it's at least going to put an appreciable dent in it. And that might be at least enough if rates are to go down some eventually when the Fed does pivot to get folks back in at lower prices. So it's kind of a process. First, we need to see prices fall and the economy soften to kind of warrant that. And then eventually the Fed turn about and then the cost of home ownership would drop because of that combination of lower rates and lower prices.
I'm just asking from the perspective of a millennial in California that wants a home one day.
Oh, yeah. Yeah, I mean, I really hope that you're able to get what you want. I think that the monetary policy, we've been in the greatest experiment in human history, the largest multi-asset bubble we've ever seen. It's extended into real estate. Prices are way out of control. Way too many people have been priced out of realizing the American dream.
Yeah, of course.
One thing we are seeing progress on a happy note, is inflation is dropping. Although we can say that core is still staying somewhat resilient, particularly core CPI. And if we drill down into that, core services are still on the rise as core goods are falling, but it's still higher than what the Fed wants to see. And so it does give us a little bit of pause. We can also see leading indicators are pointing to a recession. This is an index of 10 leading indicators. We can see it's been pretty prescient, predicting prior recessions going all the way back to the dot-com bust. And so I do think it is worth paying this some credence, because the more we look at what's going on underneath the surface, underneath some of the better headlines, the more shaky things start to appear to me. So I think that, on the other side, cash levels are high. It's great. We've got money markets flush with cash. People like to bust this chart out and say it's a great reason people are going to go back in the stock market. But what's true now that wasn't true earlier in this chart is that rates are appreciably higher. If you're in a treasury money market account, you're earning 4%. There's no reason to rush into stocks when you can just sit in cash
Right,
and earn 4%.
right. Yeah, especially in this market, right?
Yeah. I mean, quite
Too many
frankly, and Jim Cramer just said buy the dip. So we have to be terrified.
I know. And you know what? He, FOMC day, it worked out for him, but we'll see how
Yes.
that goes. We'll see if Kramer has a new reputation going into 2023. I know
Yeah.
Burry just deactivated his Twitter account again after saying sell. So it's sort of the battle between Burry and Kramer. We'll see who comes out strong.
It's terrifying that it's come to that.
I know. I agree. It's like the two extremes. And again, it sort of reminds me of anything in the market when the two extremes are going head to head. It's like maybe somewhere in the middle is right. Maybe you trade the market that's in front of you and you
Exactly.
don't try to speculate too far out.
Maybe we don't melt up or melt down. Maybe we go sideways. Sideways is a market too.
Here's the thing. I think that's probably the most brutal thing for a lot of people to deal with,
Yes.
because inherently we want bullish or bearish. We hate chop. We hate sideways. And honestly, that could be an even more painful year ahead if, we don't have one big move in either direction and it's just a lot of consolidation, because there's sort of this release that people want that I don't think that kind of market is going to offer. But I think that's why it's more important than ever to trade the market that's in front of you.
Absolutely. Like that range bound almost month of trading we had from like mid-December to early January. It was painful, but you could trade the range. It was very well defined. Ping pong.
Mm-hmm. Yep. It's a great time to put range trading in your arsenal of tools. Like we've dealt with enough of it. It's good to be mentally prepared for, and especially with options where so many people are trading 0 DTs and weeklies. That's another thing to be mindful of. The move that you're looking for could play out. Just, add a week or two onto the expectation that you have for it to get there, because consolidation is the death of a weekly options contract.
Yes. And if everyone's playing 0 DTEs, it tells us something else. They have zero conviction.
Yes. Exactly.
So we saw a lot of money in money markets. We also see that pensions are well funded. In my mind, this means they're likely to buy more bonds. I think there's great opportunities in fixed income right now. They could get better, but I think with these pensions, looking at the entire market, they're like, well, the market's still historically expensive, so maybe we'll start to pile into bonds a bit more, which would make sense. Hey, the Bank of Japan's doing it. Why wouldn't everyone else, right? They've been buying a record amount of their bonds to the point where it's actually offsetting the Fed's impact on the market. And this is really interesting because you've got the Bank of Japan, you've got the Bank of China, and you've got the Treasury General account, and they're all flooding the market with liquidity. We've gotten so much liquidity in that QT actually hasn't really been much of a thing. If we look at the chart in the bottom left quadrant, that's the total assets of major central banks. And you can see in December it perked up. And in January, I guarantee you it perked up again. And that offsets the sort of drop in liquidity that the Fed and to a lesser extent the ECB are engaging in. And we can kind of see it here. Well, we could see it with financial conditions easing, first of all. And this is easiest financial conditions that we've seen since before the Fed started tightening. It's like the market completely repriced. They said, you know what? You guys didn't do anything. Mm-hmm. None of that stuff. Everything's fine. We're going to live in a world where none of that's been priced in. But we can see that there's a strong correlation between overall liquidity in the financial system. And this is looking at the Fed's balance sheet minus the Treasury overnight account, or the Treasury General account minus overnight repos. And this has been going around on TradingView as well. And it's pretty good. It pretty much follows the S&P, and it's taking into consideration something that a lot of the other central bank liquidity charts don't, which is the Treasury General account. And that is when the Fed did QE, it amassed, trillions of dollars of Treasury debt. It earns interest on that debt every year. And it takes its expenses, it pays itself, and then it returns it to the Treasury. And the Treasury gets to spend it out of this account. And it's done so in excess of $150 billion a month on average for the last several months. So it's added a lot of liquidity back and given reason for equities to rally in the face of what appears to be a hawkish Fed, because the impacts of their policy are being offset.
Interesting.
It's weird, right? Because it's like the macro argument was, let's everyone be very bearish, but underneath the surface, there was a lot of macro bullishness happening in the short term, in the sense that liquidity was abundant.
Right. Yeah, that's why it's, like I said, for me, I try to stay in tune. Some of this stuff, I'm not going to lie, the terminology, the bonds, it's a lot to process. And it's very challenging sometimes to try to stay fixated on what, the macro means. And it's interesting here, even when you say that there are things that are conflicting. So I think it
Yes.
requires more like staying open to the possibilities of how the market could react, because it's just hard to tell.
It is. It is. And I think that the biggest challenge is when we have what we think is the complete picture, understanding what the timeline might be and always being open that there are other pieces that we don't know. I mean, if we look at the financial universe, it's like being on a limitless beach, and you might be able to scoop up a handful or two of the sand that makes up the financial system in terms of our total awareness of how it
Mhm.
works. But there's always more to learn. And there's always more that we're not aware of than what we can be aware of. So, like you said, trading the market in front of you is key. Having a sense of the macro picture and the fundamental picture and the technical picture, I find when we see coalescence across all three, that's where we can have the strongest sort of intermediate to long-term thesis.
It's all a piece of the puzzle, right?
Yes, exactly. It is. And it's the most fascinating puzzle in human history. The sort of apparatus that we've built, this global financial system that interconnects all of the things.
Mhm.
So these buybacks have been absolutely staggering since 2007, the 15 years to follow. $8.3 trillion of buybacks. Absolutely incredible.
Wow.
And it has an impact because if you're buying back a lot of your shares, you're shrinking the float. If you're shrinking the float, that means your earnings per share are going up, even if your earnings aren't going up. Your earnings per share in that float are going up. Your PE is going down. Multiples look more attractive. Quarter over quarter earnings look better than they really are because you're shrinking the float. It's a very interesting phenomenon, and it's gone on for quite a long time. And believe it or not, buybacks were illegal before the 1980s and the great deregulation.
Really?
Yeah, and they were kind of seen as manipulation.
Oh, look at that.
And now it's all the rage.
Okay.
In
Well,
fact, you could look at like how much the Fed has put into the global financial system since 2008 and say, oh, that's about the amount of buybacks that we've seen happen in the same amount of time. Not saying there's a direct relationship, but there is an indirect one.
yeah. Interesting.
And here we go. Here's that crazy chart. Look at that.
Ooh.
SPX options notional premium. Over $1 trillion every day. Never seen anything like it in the history of all markets. In fact, before COVID, the peaks were about 500 billion. Those were short-lived peaks, and this has just been a constant surge really since options became the focal point of all trading in 2021.
That chart went vertical.
Just like incredible, right? And if you think about it, just like taking the 30,000 foot view, if you're playing zero DTEs, you're out at the end of the day or before by definition, right? So there's no
Right.
overnight carry cost. So when the Fed's raising rates and margin costs are going up, that doesn't impact you as a zero DTE trader. You can keep playing the same game. The Fed's policy has zero impact on your cost to carry that because that leverage isn't carried overnight. It's actually rather incredible.
Right. Right. Yeah, your risk management just has to be A plus when it comes to the zero DTEs, because when you're good with it, if you can handle it, I think there's a sense of like fight or flight mode that can
Yeah.
come with the volatility that comes with zero DTEs. And some people do well with that. Some people don't. I mean, the way that, the contract can swing from being up 40% to being down 50% to,
Right.
thinking it's almost zero. And then at the end of the day, we get this massive rally and it fully recovers. It's not for the faint of heart, is what I will
No.
say. So I think it's always very important for newer traders to just be cognizant of, it's very alluring in the sense that those percentage gains can be massive. But, there's also a reason that option sellers make a lot of money.
Yes. Most of them wind up at zero.
Mm-hmm.
So selling that preview makes a whole lot of sense. And I think for
Raking the
everyone out there,
carpet.
yeah, and honestly, I think you make a really good point too. Like for everyone out there that's not experienced trading or trading options or otherwise, don't go to this first at all.
Yeah.
Like avoid zero DTE as your primary vocation. It's much better to learn options trading from longer time horizons where theta isn't going to eat you alive or volatility isn't going to completely destroy your sanity. You should
Yeah.
really be looking at paper trading something like this too before you do it in real
Totally.
cash, because you could be just setting your money on fire. Options are a wonderful cash furnace. If you've got too much cash, play zero DTEs. You can ameliorate that problem very
Take
quickly.
care of that problem for you. Yeah. Very true. True words have not been spoken.
And we're in the upside down right now. where bad earnings are good and good earnings are bad. Bad earnings have led to 140 bip appreciation in stock price on average. Good earnings have led to an 81 bip decrease in stock price on average, whereas the norm is a 101 bip increase for good earnings and a 211 bip decrease for bad earnings.
Interesting.
Weird, right?
Interesting. Yeah, look at that direct crossover. What's happening here?
I feel like we have a market that is very unusual. This is another one. This is hedge funds are extremely short of treasuries. And this is as the treasury is not issuing any debt because we have the debt ceiling. We've hit that. We're now using the treasury general account to fund expenses. And, you've got the Fed coming out a bit more dovish than expected. So treasuries probably be well bid between that and the fact that pensions and foreign buyers are very aggressive here. And I think it makes sense. We've seen the era of financial repression end. You can get an over 4% interest rate on a 3, 6, 12-month bill or a 2-year note. Why wouldn't one do that? So folks might get blown out on these, but this is a very strange market. Like you were saying, like what's going on with earnings? You're seeing companies that aren't doing very well. AMD's earnings came out and their GAAP earnings were 1 cent a share. That was down 98% year over year, and they were rewarded with a 10% gain today. Some very interesting dynamics going on underneath the surface. And look, it's the year of the bond. We started off January with a huge amount of bond buying, subdued equity buying. And I think that tells us that those folks that are really, really, really short of bonds may not be in the best spot after all. When everyone's piled into the boat on one side, it typically topples over. And the last chart I have for you, central banks are splurging on the shiny stuff. They are buying the most gold that they have since the late 1960s.
Really?
Pretty interesting.
Interesting.
Now, I would not get bullish off gold from this chart.
Okay.
You're going to say why, right? And it's a great question.
Why? Tell me why.
Because it doesn't make sense, right? There's all this gold being bought. Well, the thing is, central banks lease their gold all the time. And when they lease their gold, it's often put onto the market short term in the form of future sales. And that helps to drive down the price, particularly during the London fix almost every day. So I would say the more central banks own gold, it's actually kind of bearish if they're leasing it out, because central bank gold leasing has been one of the reasons that gold has not appreciated to what may be its fair value. Okay.
Interesting. This just also goes to show you how much like nuance there is. You see a chart like this and you're like, oh, gold, that must be great. I should jump on the gold bandwagon, but you're like, no, it's not quite what it appears. It's actually not a good thing, possibly.
Right. I mean, look at the central bank selling of gold in one of the best gold markets we've seen from 2000 to 2011. They were selling the heck out of gold, and yet gold was surging. It went from like $200 an ounce to almost $2,000 an ounce during that time. And now they've been buying aggressively, and gold's been, it broke that all-time high in 2022 because of Ukraine, Russia, but that was it.
So possibly a little bit of action on this chart.
Yeah, I think this is one of those sorts of charts that is sort of counterintuitive. You almost want to fade what the central banks are doing. And, you've seen this happen a number of times where central banks are sellers of gold, and it actually marks bottoms in the gold price, like the Bank of England selling a bunch of gold, I want to say in the early 2000s.
Fascinating stuff. That was thorough. I feel like I want to print that out, and I want to mark it up, and I want to ask you more questions. I mean, this was fantastic.
Thank you. Yeah, I really enjoyed the interview, and I appreciate you having me on.
Yeah, thank you so much. Before I let you go, I've got a question for you in regards to, sort of the market and what we're seeing right now.
Yeah.
And a lot of people, I think, you've been through bear markets before, right?
Yeah. Oh, yeah.
So they say bear market rallies can last long enough to convince everyone, oh, the bear market's over. This is a new bull market. Do you see us sort of experiencing that kind of thing as the market goes higher? Do people, that euphoria kicks in and suddenly people sort of forget like the macro perspective of the bigger picture view that we're in? Do you think that, all of this is just a bear market rally?
I think it's very likely. And I think it's very likely for several reasons. One of which is that if this was a new bull market to start here, it would be among the highest valuations a new bull market has ever started, which would suggest it doesn't have very far to go or very long to last. Right. But there's other deeper concerns. We haven't seen a thorough de-risking. Households still hold near record percentages of their net worth in equities. We see lots and lots and lots of retail buying and options activity. There's been no change in sentiment. Well, I'll say this. Sentiment's been beaten down, but positioning hasn't changed as a result of sentiment in a meaningful way,
Sure.
which is telling me we
There's
haven't seen the
capitulation, right? Like when we are, really in the depths of despair, there is some form of capitulation before we get a turnaround, right? It'll feel a lot more severe.
Yeah. And we haven't really had that moment of collective de-risking. We haven't really seen any disorderly selling. We haven't really seen true fear. And a lot of folks say, well, the VIX needs to spike. I don't think it does. I think there can still be some degree of complacency in the implications of what implied volatility is pricing for price variance while you have a deeper route, particularly in a market that's pretty poorly hedged. People might just decide that they want to get out of positions rather than buy protection, which would be something that'd be more likely to drive the VIX higher if they're buying a lot of puts. But yeah, ultimately, we haven't seen that de-risking event. We haven't seen collective leverage really come down that much. Margins went up significantly during that sort of COVID policy response era where central banks flooded the world with a torrent of liquidity, and they've only fallen less than 40% year over year. Typically, the bottoms from the great financial crisis and the dot-com bust, we saw that deleveraging in excess of 40%, approaching 50%. So we haven't quite got there yet. The last 6 times bear markets ended, it was during a recession after not only did the Fed pivot, but they really started to ease aggressively. And so it's interesting. A lot of folks are hoping for the Fed pivot to come imminently, but the last several times a Fed pivot has happened, it's led to a decline between 10 and 20%. There's more to go because, why would the Fed pivot? Well, it's because things aren't going well. Well, if things aren't going well, the market's going to continue to price that until it's assuaged of that concern. So I do feel like a lot of folks have, and we see it in the positioning, active money managers are the most long they have been since the spring of 2022. People are positioning as if this is a bull market or a continuation of the last bull, whether new or old. That's the sort of mentality that's being taken on. And I think we are still in a bear market because we haven't seen a lot of the kinds of changes that are likely to happen, like an earnings recession that compresses valuations further, is quite likely. It's something that my partner Aisha has spoken about quite a bit, and we're starting to see it.
I follow her. She's fantastic.
She is. She's absolutely amazing. And, there's a lot of other signs in the economy. Consumers aren't consuming. That's a big part of driving earnings. We're now in this period of disinflation. And believe it or not, even though it's something we should cheer, like you and I go to the store, prices are going up at a slower rate or even going down. That's great for us. It's really bad for a lot of companies that now no longer enjoy pricing power and are going to have to see things go down top and even bottom line. So I'd say, look, this sort of bear market environment, it can go on much longer than people expect. Bear market rallies are incredible at getting bears to turn bullish and in getting bulls to think this is a new paradigm. And it's usually at the point where it gets as many people off sides as it can that it begins to end and turn around. Exactly. And I don't think we're through the worst of this yet. And of course, I could be wrong like everyone else. I don't have a crystal ball, but I have navigated and looked at enough markets throughout history to say this would be the first time ever that we end a bear market like this and enter in a period of expansion with the Fed having undergone the most rapid rate of tightening they ever have, from 0.25 to 4.75%, 4.5% essentially in less than a year with quantitative tightening at this scale. There's a lot that we still have yet to really realize from all of that tightening. And I think when it is all realized, that sort of, as Powell was saying recently, the cumulative impacts of that tightening, think about it. Everyone who has a credit card or revolving line of credit or is going to finance any new debt has to do so at appreciably higher rates now. And every day that's going on, it compounds on itself.
Yeah, of course. Wow.
So,
that was a great response. Yeah, there's a lot to digest, and I think it's just a reminder to sort of stay on your toes and be nimble. And I think this is also a reminder that so much of the market is emotionally driven, and it is really hard when the stocks start running without you and you see multiple green days in a row to think, oh wait, the bull market has begun. And just when you want to jump on board, it's possible you might get the rug pull. So just one day at a time market.
Absolutely. And I think this is one of the reasons that, risk management is so important, considering things like trail stops for positions we can't actively monitor. So at least we have some area of defined risk. And, just understanding that we don't need to be max long or max short. We don't need to be dramatically positioned. There's nothing wrong with taking things day by day, trying to take a little bit home, like you were talking about earlier when you're trading. That's exactly all we need to do. And then from the longer time frame for our longer term investments, what I'm doing is making a shopping list, because I think things will get appreciably cheaper, and when they're on sale, I'll have no problem buying.
I love it. I love it. Wise words and a whole lot of knowledge. Thank you so much for coming on. That's a really great presentation that you put together. I really, really appreciate it. And it's something I'm going to refer to quite a bit.
Awesome. Well, thank you so much for having me, Swing Pony. I'll also send you that slide deck in email later as well.
Yeah, of course. And guys, if you're not following him, Mayhem for Markets, fantastic, fantastic account. Always up to date with everything that's going on in terms of the macro world, economic events. Great follow and a wealth of knowledge. Thank you so much.
Thank you, my friend. Enjoy the rest of your evening.
Appreciate it. Guys, that was a fantastic presentation from Markets and Mayhem. I really and truly appreciate all of the macro knowledge he brings to the table and the way he articulates, a lot of higher level stuff in a way that's a bit more understandable. Definitely a lot of speculation going on in terms of the markets, in terms of the future outlook, whether we're headed for a recession, whether we're in one. But I think one thing that we can all agree upon, especially after talking to Markets and Mayhem, who is somebody who's immersed in the macros every day, is that you really have to sort of separate your day-to-day market experience versus your longer-term market experience. So a lot of great knowledge in there. Definitely, as shorter-term traders, we do have to be careful about where our biases come in. If we're expecting something to happen 6 months down the line, maybe a year down the line, probably has very little business to do with the zero DTEs or the weekly options that you're trading. So always a good reminder, lots of great knowledge. Look forward to seeing you guys next week.